because I consider myself from a sales background. I can spot a sales funnel a mile away, right? And it gets to me because I can see what's going to come in a couple of weeks. They're going to have this course or whatever.
Yeah, because I guess with social media, it's not difficult to create a perception of a certain lifestyle.
Absolutely not. Listen, we can go to Dubai for the weekend, Saj. Yeah. We should, and we can take a million.
A bit longer, not just weekend.
And yeah, the advice I'd give is don't ignore red flags.
Yes.
So I always say I'm not the mortgage police. You do what you want, but if, for example, you are going to buy and renovate and then refinance, a mortgage on day one isn't the right thing to do. It's mortgage. Yes. It's basically mortgage fraud, yeah?
Yeah. You're telling the lender that I want a 20-year mortgage and your intention is I'm going to flip the property back on in a year's time. Shaz, are you internet famous?
I am an internet famous, yes.
What does that mean?
I guess I'm not really internet famous, but my business has been built off the back of social media and networking.
So utilizing social media and networking to build a business around finance brokerage for investors.
Yeah, I would say I've built my personal brand through, I call it a triple threat method of physical networking, online networking, and use social media.
Okay. And in your business, it's fairly crowded space. There's lots and lots of finance brokers. So what have you done using your triple approach method to differentiate yourself from everybody else?
I think I learned very quickly with networking that people buy from people, which makes sense to me now, but back then I was like, what do you mean? So it's a case of being authentic and being yourself and not being afraid to be yourself. So for example, I used to own a burger restaurant. So at networking events, I would talk about that because that was a difference maker. The other thing, Saj, is there's a lot of mortgage brokers, but they don't know how to market themselves. They don't know how to actually pitch what their USP is because they're too scared of kind of not
pigeonholing himself into
not serving everyone else. So you speak to brokers and you ask them, what do you do? What do you specialize in? And they give you the whole list of every type of finance, which means they don't do anything well. And I focus specifically on working with property investors, don't do residential mortgages to make that really clear. So by being in those rooms with investors, they're talking about their strategies, I understand their pain points and I get things done. So I think that's the difference, is I understand what they're going through, really.
Yes. What was the first property networking event you ever went to? Can you remember?
You know what? It was actually, it might even have been yours. I remember I came to one of yours because one of the other brokers has pulled out and it was find it and fund it.
Okay, yeah.
And I still remember what you said, actually, Saj. You said at that event, that if you want to raise money for deals, get on social media, do some videos, and if you care about how you look, get over yourself.
Yes.
And I remember that. That still stuck with me, to be honest.
Yeah. That's interesting. That was a few years ago now.
It was a while ago.
Yeah. And so you're naturally introverted, know each other a little while. And it strikes me as interesting that somebody that's introverted generally really struggles on social media or networking. But clearly you've recognized, actually, I need to get over that because that's where the business opportunities are.
Yeah.
So how do you deal with that?
I am introverted. I get anxious. I definitely care a lot about what people think. And that's just me. It's never going to change. But I think with social media, I realize that I'm in control. So I can share what I want to share. I can control the narrative as it was. So if I want to share the good days and the bad days, that's on me. If I don't want to share the bad days, I don't have to. And the same with networking. It's about putting yourself out there because, again, there's so many people that do what I do. Why would someone work with me?
Yes.
If I'm going to sit in a corner, pretend I'm on my phone at a networking event, then I shouldn't get any business.
Yes. Yeah, because you'll often go to a networking event and you'll see people sitting on their own on a phone. And I think sometimes that's because they just feel a bit uncomfortable speaking to strangers. Yeah. And so what tips would you suggest to somebody who is a little bit introverted, who's maybe at a networking event, how to kind of get started?
Yeah, I'm glad you asked that. So I've been giving away a lot of tips to people recently, actually. So the first thing I always talk about is pre-networking.
Yeah. In
the social media day and age, you can tell who's going to be at a Saj Hussain networking event because you posted about it on social media the day before. So inbox those people.
Yes.
Hey, Imad, you're going to be at this event, so am I. What do you do? This is what I do. Let's catch up at the event. Do that 3, 4, 5 times. When you get to the event, you've broken the ice with these people.
Yes.
They know who you are.
It's a great tip.
And it's just so much more comfortable. Second thing I find that I do really well and helps me, because I don't want to be the center of attention, Saj, believe it or not, is to be the connector, be the plug. So Imad, I'm going to use Imad, our mutual friend,
Yeah.
as an example. So Imad, what you're here for today? Oh, Shaz, I really want to speak to an accountant. Oh, you know what? So and so over there is a great accountant. Let me introduce you, and you lead them to it.
Yes.
It gives you a role. It gives you a reason to be there, and it also just makes you again more comfortable. You have more conversations with different people. Someone asked me recently, Shaz, I went to a networking event. My goal was to have 10 different conversations, but I couldn't have four because I was struggling to get out of the conversations.
Yeah.
What do I do? And I'm just like, there's different things. You can really just be honest and say, hey, Mad, great chatting to you. Let's definitely keep in touch, but I just want to make the most of the time. I'm just going to connect some other people now. And you'll be surprised that other people think the same as well. They want to leave that conversation and speak to different
Gets a bit
people.
awkward to try and okay, how do we now end this conversation?
How do we end it? And you just do it naturally and tell them the truth. You hit a network, got 20 minutes, let's speak to other people and catch up later. But yeah, I think when we refer back to the triple threat method, it's about doing it online, leading it offline, and vice versa. They all play.
So they're not three different things. It's a case of, it's not like I've got a strategy for this. It's linking them all together.
Yeah, and then it leads into what we were talking about earlier, which is omnipresence. Because people think you're everywhere because you've been in their DMs, you've been tagged, you've been shared, and suddenly it's like, oh, you're that guy. I've seen you somewhere.
That's where the label of where Shaz has come from.
Where's Shaz? So where's Shaz came from?
A polite way of saying you're everywhere.
Yeah, exactly. You're everywhere. So when I first started in specialist finance, self-employed, no client bank, no reputation, no brand, nothing. And I remember Morgan, my mentor, I was like, Morgan, can you give me a retainer? Give me £1,000 a month because I need to live. He's like, I could, but I'm not gonna because you just won't be as hungry.
Yeah.
I was like, okay, fair enough. That's the best thing you could have
Yeah, I
done.
like that. Yeah.
So I literally, for the period of like 6 months, went to every networking event. So I'm from South Wales. I went to every event in Wales, every event in the Midlands.
Yes.
Just to be seen, just to see the right people, to find my people. Who do I want to see more often? And yeah, there was an inside joke then of, oh, where's Shaz, where's Shaz? Because then I was sharing it on social media. So that's back when that links together. Go to the events, share it on social media, interact with people, and that's how you lead to success.
Yes. Yeah, I remember being quite surprised seeing you at a lot of Midlands events. And I think, blimey, he's from down in South Wales, so he's travelling up.
Yeah.
And it's a couple of hours trip each
It's
way.
2
So
hours,
it's like 4 hours there and back.
I mean, people think I actually live in the Midlands. I remember Steve Hamilton when he first met me. He's like, "Where are you from?" I was like, "Wales." Like, really? Yeah.
So with regards to social media evolving, it's constantly changing. How would you say it's changed over the last few years since you first started using it and started building a brand and a presence to today?
What I see a lot of, Saj, is especially now, there's a lot of people who've accelerated their journeys on socials to a point where, because I consider myself from a sales background, I can spot a sales funnel a mile away. All right, and it gets to me because I can see what's going to come in a couple of weeks. They're going to have this course or whatever, and there are people who are looking to monetize, which is absolutely fine, but I can see the steps they put in place. But rather than having 5-10 years of experience and substance before doing that, people having a year worth of experience of doing that. And I can spot that from day one. So I'm seeing a lot of that happening. So the advice there is do your own due diligence. If someone wants to sell you a course or a mentorship or anything, ask them a million questions. And ask them for recommendations. Say, who can I speak to that's done you? Do you have a proof of concept? Am I your first mentee? Because if that is the case, I'd rather not go with you. So drill down. And that's what I'm seeing is a lot of, I guess, lifestyle content in a way to position people perhaps in an unrealistic way.
Yeah, because I guess with social media, it's not difficult to create a perception of a certain lifestyle.
Absolutely not. Listen, we can go to Dubai for the weekend, Saj. We should. And we can take, a million...
A bit longer, not just weekend.
We can take tons and tons of photographs, videos, even just sat in a hotel because everything looks amazing there. And suddenly we can tell people, if you invest with us, this is what your life could be like. Here's our course, sign up now. It can be done. It's so easy to do it. I just feel bad when people make expensive mistakes and trust the wrong people.
And it's too common, the stories around people losing money with investing in money. They haven't really thought about what they're doing or who they've chosen to get into business with. Yeah,
and I think the common thing that people say, especially in property or wealth creation, is if the coach is making more money from training than the actual business, that's a red flag. And yeah, the advice I'd give is don't ignore red flags.
Yeah, and if it feels wrong, then you should take a pause and reconsider what it is you might be thinking of doing.
Because like you say, if it was easy, everyone would be doing it.
Yeah, absolutely. And so you're still aggressively at networking events at the moment, in person?
Try not to be.
Yeah.
I think what's happened organically is rather than being in the Midlands so often, I'm in London a lot more.
Okay.
So that's happened. But I guess it means the deals are bigger, the clients are slightly different. I'm still relatively known in the Midlands, and I'm going to go to an event later on today. But yeah, I've kind of increased all my patch, as it were.
Yes.
Next year, maybe go up north, Manchester. So yeah, I'm still at loads of events. It's good to be seen, but I've got a business to run, so I'm trying to limit where I am.
Yeah. It's being so really you're the marketeer of the business. And the best form of marketing is you out there talking to people and helping them, giving them some advice.
It is. It's good and it's bad, Saj, to be honest. Yeah, I'm the marketeer. I'm good at creating reels and all that kind of stuff. I enjoy it, right? I'm really good at it. But I think one of the risks of a personal brand is that you can become the bottleneck in your business. People see Shaz, they want to work with Shaz. They don't care that he's got this business in the background that has, other angles. They only want you.
Yeah, they just want to speak to you.
Yeah.
And they want you to write the business. They want you to understand the case inside out and know everything that's going on.
They don't want to speak to the admin. They don't want to do anything. And I think that's definitely a risk of personal branding where you can become the bottleneck to your own business.
You probably need to have a higher price ticket version of you delivering the business.
Yeah, definitely.
Rather than your team delivering it. Yeah.
And what I'm always conscious of as well is when I come to Birmingham, I could leave maybe 3 o'clock in the afternoon, get here in 2 hours, go back the same night.
Yes.
Bit of a trek, but I don't mind that. It's fine.
Yeah.
If I'm going to London, you have to stay over because the last train back is a nightmare. And I don't ever want to be in a position where I'm posting about networking events that I'm at. Clients can see it and they think, oh, that's why he's not replied to my email. Because to me, that'll be a failure point.
Yes. Yeah. And with because essentially it's finance, what you're doing, and when we had the lockdowns, how did you kind of find that transition, particularly when you were trying to build a brand around networking, going out, meeting people, attending events?
I'm glad you asked.
Then all of a sudden it's just a screen to look at.
No, I'm glad you asked. Lockdown was very interesting for me because I got stuck in Pakistan.
Oh, okay.
So I went towards the end of the year, meant to be there for like 3 weeks, turned into 3 months. But then Clubhouse became a thing.
Yes.
So you could do that in Pakistan. But I used that as a time to get my content ready and just keep on top of the market.
Very good.
I didn't really switch off. So I had admin support in the UK. I was like, guys, I'm going away physically, but I'm still here to do business and work. So we just kept going. But I'm sure any broker will tell you that lockdown and COVID was actually good for business in terms of investors, especially, were still investing. So business was manic. I physically was stuck for 3 months. And then I came back, and what I found was people had adapted really well. So there were more Instagram lives, there were more podcasts suddenly out there, and everyone wanted to speak to me on their podcasts and things like that. So yeah, it opened up a lot more doors for me, to be honest.
And from the networking side, did you continue to go to online networking events?
I wasn't a big fan of Clubhouse.
Yeah.
I think I don't have the attention span of just audio only, unless it's a podcast. But Clubhouse, I just wasn't a big fan of. So I didn't do any of that online networking. What I did do instead was, you got the Instagram lives. So I jump on a live with someone, answer some Q&As.
Yes.
Yeah, so I did do a lot of the online stuff.
Because a lot of your work is around guiding through the understanding of which is the right finance products, or often I see people set out to do a particular project, implement a certain strategy, but they've only thought about how to get into the deal. They haven't thought about how am I getting back out of it. Or, do I need the finance in the interim? Does it need to be for a certain period of time? How am I going to exit out of this? And often the focus is just on getting into the deal rather than actually seeing it all the way through and coming out the other end.
Yeah, I try and look at what I do as one is to myth busting. So these are the common misconceptions people have, and actually none of these are true because of X, Y, and Z. 2, like you said, you don't want to go into a project that you can't exit out of. So it's to avoid expensive mistakes. And the other thing I often do with my content is to do the reverse. So instead of saying this is what you can do, is to say don't do this or avoid doing this. Because it's the reverse message.
Yeah, and I mentioned this to you earlier that I think you're one of the first brokers I saw that would openly share which lenders are doing what. So for example, someone's talking about online, they're trying to find a mortgage lender that provides service accommodation, a mortgage, for example. And brokers would say, yeah, I can help you with that, and I can help you with that. And you would say, yeah, this is the lender that does it.
So honestly, this is, again, mortgage brokers not understanding how to market. So you go on Facebook, all these property Facebook groups. Imad says on there, I need a mortgage. This is my rough idea of my situation. and it becomes a meat market.
Yes.
You'll get 20 comments with people just tagging themselves. I can help, call me. You get 5 comments with people just referring their broker on. But if you're the person that says, okay, based on what you've said, this is a lender that might do it, and if you want more information, get in touch.
Yeah.
You stand out for the right
Yes,
reasons.
absolutely.
However, I've been told off by brokers for doing that. They're like, why are you giving business away? I'm like, I'm not giving business away. If anything, I'm showing that I know what I'm doing.
Yes.
And if someone goes to their own broker with that lender, that's absolutely fine.
Yeah, because what you're doing is delivering value first. You're saying, look, let me give you some value and explain, and then you can make a decision whether you want to work with me or whoever you decide to go with.
Because if that investor's got a list of 20 people to call, and they've called through everyone, are they going to want to call through 20 people, or can they say, okay, this guy actually knows what he's saying, let's just call him direct?
Yes, that makes absolute sense. And how have you finding the current state of the market with the interest rates rising, potentially another rise happening tomorrow as we film?
So I think I've used the word swap rates more in the last 3 months than I have ever, but it's good. So it's good for investors to understand these things. So the base rate going up or down affects tracker mortgages because they track the base rate up or down. But what affects fixed rates is something called a swap rate. That's a SONIA overnight swap rate. Now that's when lenders lend each other money for a period of time.
Which used to be, is it LIBOR?
LIBOR.
That got scrapped.
Exactly. So it's that. Now that swap rate has been incrementally, only by small numbers, been decreasing, over the last year. So fixed rates are going down. I think what I'm finding in the market is that investment lenders, buy-to-let lenders, increasing their fees quite a lot.
Yes.
So we've got lenders doing rates of like 4.5%, maybe 5%, but with a 5% fee. But if you spread that fee over the fixed term, there isn't a benefit. So fees are going up, rates are creeping down, but it depends if you want a tracker, a short-term fix, or a long-term fix, and it's about your circumstances. Yeah.
So there's no one size that fits all when it comes to general kind of mortgage product, which is why there's an array of these things that exist.
Yeah.
But what can be a bit of a minefield, understanding what's the right product. So for example, as you mentioned, you might find a product that this is a 4% rate on this particular product, but actually it's whacked with a 5% fee, or some other way they put it together. So when someone is looking at a mortgage product, what are the key things you think they should be looking for to understand to get a true comparison?
So the way I always do it with my clients anyway is I'll give them the lowest interest rate, regardless of fee. But then compare that with the lowest cost over the fixed term.
Yes.
Now, that's a choice between cash flow and paying least amount of interest back. So some people will go for that 5% with a 5% fee because it means even
they're not physically paying it out of their pocket themselves. It's been added onto the debt.
Exactly. And it means monthly the payments are lower. So cash flow wise, they're benefiting. But there are some people who say, Shaz, I just want to pay less interest over the 5 years. I'll go for that. So it's cost versus monthly payments is what I'd look at anyway.
Yes. And what do you think the lender's appetite is at the moment? Do you think they're kind of hungry to lend? And I mean, I get a sense that because I speak to a lot of people who want to invest in property, and I get a sense there's no shortage of money out there. A lot of people are still sitting on quite a lot of money.
Yeah.
And that's been the case for some period of time now. How do you think lenders are seeing the market? Are they kind of hungry to lend, or are they kind of cautious right now? Or
I think lenders are keen. I mean, we've just seen yesterday Skipton were launching the 100% no deposit mortgage for renters. And that's residential mortgages, but I still keep on top of it.
So that's the first 100% mortgage for quite some time.
Yeah, but it's interesting with that. So you have to show that you've been renting and paying rent for 12 months, that you've paid the household bills. You have to have really clean credit. What I find interesting with that is, let's say, because you're putting no deposit down, it means the house you're going to buy is going to be less valuable than the house you could buy with a deposit. So actually, if you want your dream house, you might actually want to have a deposit because you're not going to borrow as much. But that's a good way of getting on a ladder. But what that will have, I think, is a knock-on effect. If more lenders do it as well, is house price will go up. Yeah. Because there's now more buyers in the market.
It's easier to access the... Yeah, because what's holding people back from buying is not the appetite is there for them to buy, but the means aren't.
Absolutely.
So if the means to buy become easier, i.e. no deposit, then I suspect a lot of lenders are not going to jump onto that bandwagon. There'll be a small market.
Yeah, I think it'll be the specialist lenders and things like guarantors. They want something as a security. But I think, Saj, banks can't win. So, we've been saying for a while that rent should count as experience and that should factor in, and this does it. But then I see some of the comments, people are like, it's a trap. You're going to end up with negative equity. Well, you've got to have a middle ground. You've got to have something, give and take. So, yeah, lenders can't really win, unfortunately. In the investment market, like you said, the money is there, but I think accessing it is a little bit more difficult. Lenders these days are really hot on source of funds. So it's all great. You've got the money, you've got the deposit in your account, but where's that money come from?
Yes, they want to see a trail of the
Trail of
source.
funds. And then when it comes to like bridging and things like that, you can use investors' funds. Okay, well, where'd they get their money from?
Yeah.
And that becomes a challenge because investors may not want to give you the bank statements. They may not want to do all these questions. So I think lenders are questioning more around these things.
And so when we talk about different finance, you got your main high street lenders that you kind of walk up and down the high street, you see those brands. Then you got specialist brands that will work within the kind of investor arena, and then you've got like bridging names you may not even have heard of at all. And do you see them as viewing the market the same, or do you think they're approaching it differently because they target slightly different
I
clients?
suppose that the high street lenders, they're going to be very, very vanilla, very black and white. They've got banking licenses, or they've got building societies, and they got their members and shareholders to appease. So their risk appetite won't be as high. But then you see in the press that Lloyd's, for example, are going to become a landlord. They're going to do all these houses. So they
Ambitions
can
be one of the biggest landlords in the country.
Absolutely. And then the specialist lenders who are off of the high street, they can take more risks. But what's interesting is a lot of those are funded by some of the institutional banks. So they've been given a pot and said, we want this return, just do what you want. When it comes to the specialist bridging lenders, the short-term finance guys, I would say their risk appetite depends on how they're funded. So you've got some that are principal lenders. They just lend their own money. Or the wealthy families or just investors who pulled in a pot of money. They can take a bit more risk because it is their money. They don't care about the banking of England base rate. They just want a return.
And all that falls into unregulated sector.
It's all unregulated.
Because there's no kind of FCA compliance as such there.
Correct, yeah. So they can just lend. And then you've got the non-principal lenders who are just lending from other banks. So whilst they're a bit more reliable, they are very risk averse, I'd say, as well. They ask a lot more questions because at the end of the day, it's not their money. And actually, it's someone's savings that they're lending out. So it depends how they're funded.
And are you seeing, and I don't know if you are in your line of work, where loans are being called in or borrowers are getting into difficulty, repossessions are being increased, whether that's on short-term funding or regular kind of mainstream type finance?
Touch wood, I've not seen that happen on either. I think people start asking me this question, especially around bridging short-term finance, that look, I've got a 12-month bridge. If I don't pay it back, what's going to happen? Are they going to take my house off me? I'll be honest, the cost of repossession, the legals and everything else, it probably cost more than it would to extend the loan. Lenders will love to extend your loan because they can then charge you like a 4% renewal fee.
Set it up,
all the fees. Suddenly you've got to pay the interest each month on a direct debit. So they'd rather make that money in fees than take you to court. So it just doesn't happen. As long as you work with them, tell them what's going on, you know, the sale's taking a bit longer or the refinance has taken longer, they'll do it, but they're suddenly going to whack you with a lot of fees.
And lenders are not in the business of collecting houses. They're
not asset managers.
From money.
Absolutely.
And do you get involved with the development finance at all? And how are you seeing that market because if let's say we're going to develop something now, build it out the ground, by the time we exit out, it could be a year and a half. There's still some uncertainty where we're going to be in a year and a half's time. How are those type of lenders viewing the market?
I've been pretty busy with that, but what I'm finding the feedback is from lenders and credit committees and so on is a lot of the newer investors, they're getting pushed back or getting asked more questions because one, if they've got no assets, it means their PG position, personal guarantees, just don't mean anything. So no assets, and it doesn't really mean much. So I've had weird and wonderful requests saying, okay, so Saj wants this loan, it's his first project. His residential house is also co-owned by his partner. She's not on the application, but she's gonna have to give a personal guarantee as well. Weird things like that, and they can ask for these things because they're securing their money. Also experience. So if it is your first project, they'll want to make sure that your project manager has done 3 or 4 or 5 similar projects and what's their kind of liquidity position. So more questions are being asked about the actual project and sustainability. In the past, I've been able to use fixed price contracts from these people and say this is what's going to cost. Lenders now want to see a full-on schedule of works with contingency factored in, 15% normally.
Wow.
And suddenly, how that impacts you as an investor is it might mean you can borrow less, because even if you don't need that money, because it's factored in, your loan will be lower.
Yes. And one thing that we were talking about earlier on in the office and some of the video content I was doing today was the buy-to-let market. A lot of it is fueled by buy-to-let mortgages, where the current rates are at the moment, the way inflation is, and does it even still make sense? Are you seeing people still actively doing traditional buy-to-let, or are you seeing that starting to change?
Yeah, I'm seeing people switch strategies. So a lot of my business now is the short-term let service accommodation type
Yeah.
model. And the way lenders look at that, there's two ways. They can either treat it like a holiday let, need a letter from a local agent, high, low, medium figures, use an average for affordability, or they can just use it as an AST, see if it works, give you permission to do Airbnb.
Yes.
And from a cash flow perspective, you know more than anyone, it's that works really well.
Yes.
But again, to access that funding is more difficult than it would be for a traditional buy-to-let.
Yes.
But yeah, people are switching strategies. I've seen people now do like commercial conversions into semi-commercial rather than full resi, just
So
because it's
mixed use.
easier.
Yeah.
Multi-unit blocks rather than HMOs because of planning issues. So yeah, I've seen people diversifying.
Yes. And there's also, I think people are starting to realize that if you're going to do traditional buy to let, you're not really making any money today. You're building up something for the future, but you're not going to make much money today.
On that though, what I would say, because people say, Shaz, what do you think rates going to do? Shall I just wait another month till they come down? If the deal works now, even at a minimal level,
Yeah.
then it's always going to work because it's
Yeah.
the worst time to do it now. So I think timing the market is the worst idea. You can never
Yes.
time the market.
Yes. And even with your knowledge and the closeness to kind of the cutting edge of what's happening in the market, you can't really gauge where the market's going to go in the coming months or year or so.
No, it's interesting. I was invited to like this dinner with, they call us thought leaders. I'm a thought leader, Saj.
I saw that posh Instagram.
Did you see the video?
Yeah, I saw
So
it.
I was at that event, and it was just an open conversation with lenders and solicitors and other brokers, and everyone pretty much said the same thing, that it's not a case of the money is not being there. It just has to be lent in the most responsible way
Yeah.
because they don't want to be having to call in loans or chasing people or anything like that. So lenders are now trying to be a bit more open and flexible with strategies that they can accept, as long as they can understand what's going on. Because I think, like social housing, for example, a lot of lenders don't like it, and it's the whole vulnerable tenant aspect. But the problem with that is, right, you've got all these social housing providers, even when the tenants are not vulnerable. So, for example, like asylum seekers.
Yeah.
When I say not vulnerable, I mean they just need a place to stay. They're not, yeah. But if you go on that provider's website, I guarantee you it says we help vulnerable asylum seekers
Yeah.
because they need the funding to help that. Lenders see that, underwriters see that, and decline the case.
Right.
So I think that's when using a broker is really important because they can package it and say, look, even though it says that on the website,
present
these are
it
the
the right way.
tenants and so on. Yeah.
And I guess that's somewhat we were talking about earlier on off camera. The value you provide, it's not here's a product. It's not like a commodity. It's understanding and wrapping the needs around the borrower's needs around the lender's requirements to make it all fit.
Yeah, I mean, look, this might sound silly, but if you're going to be a hobbyist landlord and you fit the high street, you probably don't even need a broker. Just go to the high street, go to Lloyd's, go to your bank, and they'll give you one buy-to-let mortgage.
Yeah.
But if you're going to be a property investor,
You want to build a business.
you want to build a business, then you need a finance arm, and that's essentially what your broker becomes, is your finance arm for raising finance. Yeah, it's about packaging the case properly. It's about making sure that there's less touch points. Ideally for me, when a case is in, I don't want to speak to the underwriter again until we have an offer. Obviously, it doesn't happen all the time. There's lots of back and forth. And then with that back and forth, it's a lot of what I call firefighting. I may never tell you what's going on, but there's a lot of explaining to the underwriter what this is, here's the rationale, so on and so forth. And then you've got so many things that are out of your control, like valuations, for example. And we're seeing some things being downvalued now,
Yeah.
where it just makes no sense. But the problem is, valuers have to use land registry for their comparables, and land reg is what, 6.9 was that date?
Yes.
So there's all these challenges, all these things. It's not as easy as, I've just put your numbers into a sourcing system. Here's the cheapest lender. It's not that.
And do you think valuers are a little bit nervous at the moment and they're downvaluing as well?
I think there's that. They're definitely risk averse because at the end of the day, they're signing off on,
Yes.
on these numbers and their insurance covers that.
Yeah.
But yeah, they're using data that's old, essentially. If the market has changed significantly, that's not reflected for another 6 months.
Yes.
What I say though, people come back to me, Shaz, we want to appeal this, we're not happy. I will always support you, but it's very rare that a valuer changes their opinion because what you got to realize is when you challenge a valuer, the appeal goes back to them.
Yes.
So they then have to admit, yeah, I was wrong.
Yes.
Change the figures.
Yeah.
That will affect their relationship.
Yeah,
with
and
the
that
lender.
property investor who's got no qualifications or letters after their name has said that they're right and I'm wrong and I've got to admit I'm wrong.
Exactly.
I agree with you. I when people say to me about challenging value, I said forget it, just find another lender.
Find a lender. And the thing is as well, some clients say, look, Shaz, let's get another valuation done. Okay, well, look, if that comes in favorably, who's to say who's correct? Let's get a
Yeah.
third one then, shall we?
It's an opinion.
It's all it's
It's an
a qualified opinion.
Yeah.
Mhm.
Yeah. And so someone that's starting out at the moment, maybe trying to access their first lot of finance, whatever strategy they're looking to do, what are the most common mistakes you see people making when they're just trying to get started, looking to tap into their first lot of investment finance?
I think first of all, again, strategy. It depends what strategy they're doing. So let's say they're doing BRR, buy, refurbish, refinance. It depends who their kind of education comes from. Some people say get the money ready first, then find the deal. Some say get the deal, then find the money. I think when you're approaching a broker, we'd rather you have the money ready
Yeah, yeah.
because from a lending side, yeah. So yeah, not having the funds ready, even if it's investor funds, you know, you want to make sure you've got that in place. Secondly, is not being on top of your credit. But I think that applies to everyone.
Yes.
You'd be surprised, right? On credit files, your credit number doesn't matter. I don't care if you've got
Yeah.
999, that does not mean anything. It's about your conduct, late payments, defaults, arrears. But the biggest one, Saj, is CCJs. Like in the UK, it's so easy to get a CCJ,
Yes.
especially for parking tickets.
Yeah.
And sometimes, and maybe you know, I'm just throwing money away. Sometimes it's probably better to pay that 60 quid parking fine than get a CCJ on your
Yes.
record, right?
It's not worth the risk.
It's not. You know, people give CCJs out willy-nilly, right? So all these things can affect your lending. And also with the credit file is associations. So you've got ex-partner
Yes.
and they've got terrible credit, but you've lived with them at the same address. That can bleed onto yours as well. So these things are things to be
Even
on
if
top
there's
of.
no shared accounts.
Yeah. Because just on the voters roll, you've got the
Yes.
same property.
address.
Speaking of voters roll, make sure it matches your address history. Lenders are really funny about these things. They want to make sure you've been living where you say you've been living.
Yes.
And then yeah, that's one of the challenges. The other thing I think with newbie investors is they just don't understand or don't have the kind of context around rates and costs and fees. So it's a case of, have I got to pay legal fees? Have I got to pay broker fees? Have I got to pay valuation fees? Okay, if I'm paying a valuation fee, can I choose who goes out? Or can I get a copy of the report? Some lenders don't give you a copy of the
Yes.
report.
Yeah, they won't
know?
give the report, yeah.
But then that's I suppose why I exist, is to educate and to make sure they're doing things the right way. The other thing is shortcuts. So I always say I'm not the mortgage police. You do what you want, but if, for example, you are going to buy and renovate and then refinance, you know, a mortgage on day one isn't the right thing to do. It's mortgage. It's basically mortgage fraud, yeah.
Yeah, you're telling the lender that I want a 20-year mortgage, and your intention is I'm going to flip the property back on in a year's time.
And again, some of the newer investors, because they've seen all this stuff on socials, it looks sexy. They'll come say, no, well, so and so's done it, or so and so says they can do it. If push comes to shove, I'm like, look, here's the phone number for the lender. Tell them what your plan is. Ask them to lend you the money. When they say no, come back to me. We'll have a chat.
Yeah, and lenders are very cautious by their very nature, and just little intricacies like what you're talking about, like credit file, voters roll, all these things. You know, they've got lots of little tick boxes, and they want to make sure you fit nicely into that. And for a lot of lenders, if you're even slightly out, that's it. We're not interested.
They'd rather lend to you or someone who's completely clean.
Yeah,
And that's the risk
a
appetite.
clean client versus one that's slightly off. They'll just go for the clean one every time.
Absolutely. One thing I want to mention, Saj, as well, just somebody you spoke about this, the thought leader dinner, is we're talking about timescales from lenders saying, well, why are things just so slow? Because, you know, as a broker, I can be as responsive to my clients and get back to them. But then if once things are paid and fees are paid and the application's in, it's taking a week just to get an update. Why? What's going on? The conclusion we kind of came down to was that it's part of it is this whole work from home thing. That if you've got a
Or
team,
not work from home.
yeah, and if you've got a team of underwriters who are in the office and they can talk to you about cases and actually be in the office, it's quicker. When you got people working from home, they're not doing a full day guaranteed. They're getting distracted. They've got no one to soundboard ideas from, so they send an email which might take a couple of hours to respond. But it's the knock-on effect is speed and service levels. Lenders like Shawbrook Bank, for example, at one point they're on 27 days to review valuations. It's ridiculous, you know.
Yeah, I had one stuck with them for a very long time, which I was getting really frustrated about.
Yeah, and that's the thing, you know, your broker could come back to you every day and tell you what's going on, but if the answer is there's no progress, what can you do?
Yeah. So let's talk about the holy grail of no money left in and doing a deal and getting all your money out and a house for free. Are you seeing a lot of remortgages like that are successful in that way?
At the moment, I'm not. I think in the current market and the current climate, getting a deal with all your money back out, it's very, very difficult. And that's where people have got to realize is if they're using investor funds, then actually if you can't pay your investor back, how is that going to be okay?
Yeah.
If it's your money left in, that's
Yes.
fine. But when it's investor money, what is going to happen at
Yes.
that point? Do you have funds to plug that gap? Some of the investors I work with are doing larger deals where it's HMO conversions into like 7 beds plus. Because on the back end they get an investment valuation based on the income.
Yeah.
I'm seeing that being very successful. But then not a lot of newbie investors do that. They start off with the smaller stuff.
And they probably wouldn't be eligible for that kind of finance. So if somebody's starting out as their very first deal, they purchase a property, convert it to a 7-bedroom HMO. I'm guessing they probably won't be able to access a commercial valuation of your mortgage.
Exactly. That's where we talk about exits, making sure you can come off the bridging that you're going to come on. If you're a first-time investor with no assets, you live with your parents or renting, and the first project you've seen is a conversion to a 7-bedroom HMO, you've got planning. Can you get a HMO mortgage just based on the income off the back of that? Probably not. So you want to source that on. Or one of my clients, what they do is, and he's really successful, is every project, he calls it investors, and it's not an investor, it's a JV. So he sets up a new SPV company with each investor. They keep the asset on the back end. And what he's found is he can actually get new people on board. So if you've got someone with money, they can JV with you, benefit and leverage off of his experience and his relationship with the lender and get the investment files on the back end.
Oh, so he's keeping a share of each deal, as it were, in a separate SPV. That's an interesting way of approaching it. If you were starting in property on the other side of the fence, i.e. not in your current role, and you were looking, and with your knowledge of the finance market, which route or strategy would you follow, assuming you're starting a small amount of money?
Good question.
I'm putting you in a bit of a spot.
No, it's a good question, and no one's asked me that before, Saj. So what would do? I think I would do a few strategies. Maybe rent to SA, especially right now. Cash flow is amazing, and flips to build the cash pot.
Yes.
Because you got cash flow and you got your cash pot, and those two things can help a lot.
Yes. And with someone that is flipping, for example, what's the sort of best way to finance a flip?
Ideally, look, if you've got your own money or investors' money, use that.
Yes.
Friends, family, investors, just use it. Don't get the funding.
Yes. Always been my preference.
However, I think the only thing is sometimes people can back out.
Yes.
Your uncle's got loads of money because it's not his day job or business to lend money out for property. You might, at the last minute, say, you know what, Saj?
Yes.
I spoke to
as lovely as you are.
Yeah, I spoke to the missus. She does not want me to give me 50 grand, right?
Yes.
That can happen. I've seen it happen. Whereas, lenders, bridging lenders, that is their business to lend money for a return. So yeah, if you haven't got access to capital that way, bridging finance is the way forward. You can get roughly 70-75% against the purchase. You get money for the works if it's appropriate. But the numbers have to work.
Yes.
Because as soon as you start factoring in lending like that, I think the rates are pretty much the same, I'll be honest. It's the fees. Once the fees start adding up, suddenly that deal is going to make you 20 grand, now makes you maybe 10.
Yeah.
And then
because the costs are involved. So when looking at say a flip type deal, when we talk about getting the numbers and the numbers to stack, and let's say, let's use some simple numbers. Let's say purchase price 100 grand and you've got a 20 grand of spend to do on it. It'll be worth 150 at the end. So you've got 30 grand profit in theory by putting 120 in and you're making 30 grand. So when you tie in funding with that, so you could get probably a 70% bridge to buy up front. So you need your 30 grand, but they'd probably deduct the interest up front.
That's with the interest off. So you'd get 75%.
Okay, 75%. Okay, so you end up with roughly about 30% of it you're putting in up front. And tapping into refurb money, are bridges open to that or only for bigger developments?
Bridges are open to it because it makes their money. Me personally, I think anything less than a 50 grand refurb is not worth it, purely because you have to forward fund it yourself. Or not all of it, but say 10 grand.
Yeah.
Then they give you a drawdown. But each drawdown
I understand what you mean, but not everybody listening may, so just elaborate a little.
So let's say in that example, was it a 20 grand refurb?
Yes.
Fine, so that 20 grand refurb, the lender will say, you show us as well. So we have to have evidence you've got the 30% deposit, plus some money to start the work off. How much that is, kind of up to you.
Yeah.
But it's got to be worthwhile. So let's say you've then, from that 30, you've got £10,000, right? You do that work. You then send the lender the invoices to show that you've done it. But that's not enough. You've then got an asset manager to visit to sign everything off. That visit will cost £300 to £400 each time. So, and then you get the drawdown and you recycle that money. But then if you're getting 3 visits, that's 3 lost to 400 quid.
Yeah.
And that's where the fees add up.
Really adds up, yeah. And that's why the bigger projects, it makes more sense to do that, like on a
Absolutely.
bigger development, as opposed to a little renovation.
Yeah, what I find with bridging and development is the economies of scale really apply. So the fees on a small deal relatively quite high, but they don't double in size for double the size of bigger
Yes.
deals. Yeah.
So the administrative costs in setting up that loan for the lender is probably going to be about the same. So if you're buying a small loan, you're still going to be paying those costs. And if it's a big loan, percentage terms, it'll be a lot lower
Yeah.
in terms in proportion to the amount of money you borrow.
Yeah, I mean, just to give you like another example is I've done small loans, so 50 grand purchase price in South Wales, still available.
50 grand, still possible.
Well, it was about a year ago. Yeah, not anymore. So 75% of that is 37,500, less the interest by 35 grand. And I said to the client, look, here's the terms. But do you have any other way of getting this money? Because you can access 35 grand,
Yeah.
but it's going to cost you 2% admin fee, which is added back on. I'm going to charge you £1,000. The value is going to charge you 300 quid. Legals for you and the lender is going to be about 1,500 quid. It's going to cost you about 3 grand all in up front to borrow 35.
Yeah.
Is it worth it?
Yeah.
That client had no other way of doing the deal, so they did it. But I think it's worth factoring that in.
Yeah, I think with finance, one of the key things to realize it's not just the headline rate. You've got to look at your true cost of borrowing
Total cost,
over
yeah.
that period of time.
And there's things, we can get as creative as you want. You want to get this project, you need 100 grand all in, fees, everything. If you've got other assets in the background, leverage. So leverage. You can leverage up other assets. You can get 100% funding, as it were. It's not 100% loan to value, it's 100% to your costs because you've got something else in the background that you can secure against. So it's weird and wonderful ways of doing
So
it.
like that. So going back to our example earlier, let's say you're borrowing 70,000 on that 100,000 purchase. The other 30,000 you could borrow off something else that you've got. So in total, you've got all the money to do the project, but the money is secured against other assets.
Yes, you can even do that on your main house that you're living in. But, and this is where we spoke, Saj, about money in, money out deals. If on the back end, when you're refinancing or even selling, you're not getting all your money out, how are you going to how the charges are going to be discharged?
Yes. Let's talk about Sharia compliant funding, halal finance or halal mortgages. Firstly, that's something you help with.
Yeah.
And so, what are the general options in the market? Because I guess one of the things I've seen over the years, when I first started, there were a few different operators. You'd had your HSBC and Lloyds and such also in this market, and it seems to have just fizzled out and into very few operators.
Before I start this, I just want to say, with Sharia compliant, it's all down to everyone's individual faith. Get an opinion from a local scholar.
Because people have got different views on how halal something might be.
How appropriate it is. So I don't
how
want
it's
to
being dressed and put together. Because the details in the contract, I was going to say the devil's in the detail. The details in the contract really determine, how comfortable you are with it. And ultimately, for comparison purposes and FCA compliance purposes, they have to compare the rates to traditional interest anyway.
Yeah, so just be mindful of that. I don't make no judgment. But yeah, in terms of Sharia compliant, there's still like less than a handful of lenders. You've got your Al Rayyan Bank, Gates House, a new one called Stride Up have launched as well. There's a few others, not many. And yeah, they've had sheikhs and scholars look at it and kind of give them the sign off to get the funding. What I find that happens, Saj, like we discussed earlier, is I'll have someone say, Shaz, my key thing is I want it to be halal and Sharia compliant, so make sure you keep that in mind. So I'll present them what the rates are. And I'll be honest, invariably the conversation then leads to say, Shaz, just out of interest, if it was a normal buy-to-let, what would that look like?
How would it compare to a traditional
banking normal
product?
And then when we do that comparison, they'll find that the Sharia compliant products have a slight premium on them.
Yes.
And again, invariably people say, okay, you know what, for this one, we'll just go with a standard interest-bearing buy-to-let mortgage. Maybe in the future we'll go to Sharia.
I think if people want to get involved in a product that is doesn't have any interest in it, the way it's set up is completely different to a traditional mortgage. And I always say, look, if your values are important, be prepared to pay more. And if you are not prepared to pay more, then it's not going to work. You just have to accept that those products
it's
are
a tough
more
one, though,
expensive.
isn't it? I mean, because I always question why they're more expensive. Because they've got the same license, it's unregulated. So to me, it's
I would say the way the model is different to traditional banking.
Yeah.
So their cost base is different. So I understand and I'd accept that. Look, they are more expensive, and and there isn't enough of them. The market isn't big enough.
That's it. There's
And
no
not enough
competition.
people are taking on those products for it to grow.
Yeah.
That's what it comes down
That's
to.
all it is.
Is that chicken and egg situation?
Yeah, the supply and demand isn't there. Just to also add, yeah, in terms of short-term finance and bridging, there are lenders in that market. Offer, OFFA, one of them. So there are options. If you want to do an end-to-end, refurbishment project and refinance, you can do it. But just look at the cost and the fees and the rates. And if you want to compare to a standard buy-to-let, you can, but it will be cheaper on a standard buy-to-let.
Yes. So someone's watching and listening to this right now thinking, what on earth are they talking about? Just to clarify, so Islamic finance,
Yes.
meaning there shouldn't be any interest anyway in the transaction. So essentially it's profit share based. It's you're sharing risk and reward as opposed to fixed rate returns.
Yes. A few challenges I've had with these, though, to give you some examples, is I've had one, not recently, quite a while ago, where customer was buying a flat. Because of the way the home purchase plan, so these Sharia products, they call them a home purchase plan. The lender buys
Is the investment or home purchase?
Buy-to-let.
Okay.
So they buy the property and then kind of rent it back
Rent
to
it
you.
plus a portion towards the
Yeah.
payment.
But because it was a flat with a leasehold freehold situation, the lease stipulated no subletting.
Right. Okay.
And now we were like, this isn't subletting technically because it's a Sharia compliant setup, but we couldn't do it.
I could see the freeholder not understanding
Yeah,
what you're doing.
the legals just totally stopped.
Yes.
And we had to find a traditional buy-to-let lender. So that's one challenge, is just to understand that if you're buying a leasehold and the lease says no subletting, which it invariably will,
Yes.
are they going to be okay with Sharia compliant funding because of what's going on? Another that I've had recently very interesting is we started off on a Sharia mortgage, buy-to-let mortgage. And then the client said, look, I just want to remortgage onto a normal buy-to-let for now, just for whatever reason. That should normally be a remortgage. But because of the home purchase plan element, that became a purchase at legal stage.
All right. They treated
Because
it as a
of-
purchase
treating it as a
because
purchase.
the lender's the one that's effectively the owner at that stage. The ownership hasn't transferred.
Exactly. But what happened there, the impact really was, it was all fine, but it took about 2 weeks for the solicitors to get their head round how are we going to treat this and what's
Yes.
going on. So
And
those
in that one, did they treat it in the end as a remortgage or did it have to be done as a sale
purchase.
and purchase? Wow. That's interesting.
yeah.
How do you think this market will evolve? Do you think it will grow? Because I think in the UK we're probably already way ahead of most Western countries when it comes to Islamic finance, but it's still tiny.
Yeah, it is still tiny, but I think I'm on LinkedIn a fair bit, and there's a lot of people on LinkedIn having these conversations. But it's about the awareness and the distribution of that information, and it needs someone just to champion it and making it a bit more normal and a bit more mainstream. I think there needs to be a mainstream avenue where, and it's all about branding, isn't it? We talked about branding earlier. It's about branding it and just being this is another option for everyone who wants Sharia compliant mortgages.
Excellent. Shaz, always a fountain of knowledge. What's the best way for people to reach out to you and connect with you?
I am always on Instagram.
Yeah.
So its Instagram is @where's_Shaz.
And we'll link that up in the description as well.
Perfect. Yeah, I'm always there. I'll get back to DMs pretty quickly.
Pleasure speaking to you. Thank you so
Thanks
much,
for having me,
Shaz.
Saj.
Thank you.